Hey guys, this is Toby Mathis with Anderson Advisors, and I want to just go over with you the rules for short term. Specifically, we're going to talk Airbnb and VRBO. I'm just going to call it Airbnb to make it easy. What type of income and how it is taxed and what the rules are, because there's a lot of bad information out there and from very good people, by the way. It's just I tend to like to focus on things that are actually law instead of kind of going off of what I think it might be. I want to actually use the precise rules. To do this, I'm going to use my white screen. So I'm just going to pop this over here and I'm going to flip it. So you're going to see me up in the corner, but I really want you to focus on kind of the, we're going to go through a little bit of a learning tree here so that we are able to hit all of the things that are really important. So let's start here, kind of number one. So we're going to talk about Airbnb. And the first thing we always have to figure out is the number of days that we have the units rented or occupied. And I'm not going to really distinguish between those two. And you divide it by the unique renters. So if I had it rented for 200 days and I had, let's say, 30 unique renters, then I would just take my handy calculator out and I would say, all right, I had 30 people for 200 days. I'm going to divide 200 by 30. That gets me to 6.6. So that tells us something right there. The reason this is important is because this average rent, so this is the average occupancy, the average stay, is 7 days or less. So if we're 7 days or less, it's going to trigger something. First thing we're going to look at is right away, we're going to go and say, all right, is that actually a passive activity or is it a trade or business activity? And so we'll get there in a second. The other thing I'm going to look at is what services were provided. And I kind of prefer that you do this without knowing what the rules are, because otherwise you're going to make a mess and you're going to do things that you're going to wish you hadn't, like you'll make stuff up. So what services are provided? So for example, check-in, easy check-in, check-out. Are there linens? Hey, do you provide, like, do you make the bed for them? Are they coming in? Are they bringing their own sheets? Made bed. Is there cleaning services? This is one of those weird ones. Cleaning services before or after, like, are they coming in and are they getting a space that's, reasonably clean? Are you going to clean during the tenancy or during the period of time they're staying? Are they going to clean after? Are you going to make the bed? Are you going to clean it up? Are they doing any laundry? See if I could do that right. Laundry. Pretend you can read my writing. We're going to make this make sense after a little while. But it's going to get a little funky. First off, is there coffee, snacks? Is it waters and stuff in the fridge? Is there flatware? All these things, are they kind of, hey, is there a concierge? See if I could actually do that right. I know there's a G or something like that on it. Are any of these things being provided? Because it makes a big difference when you're talking about taxation on a certain type of taxation. What is not what we don't worry about is like heat, air, AC. We don't care about lights, cleaning of outside or common areas, public entrances, stairways, lobbies, all that stuff, trash collection, we don't have to worry about, so forth. What I care about are these guys over here, because these are for convenience of the occupant. And all of these will factor in for something here in a second. Then we keep going. I'm going to move this up a little bit. And then we're going to say, did you materially participate? In other words, and and I should say it in a different way. To what level did you participate? So who managed the properties, who handled bookings, who cleaned, prepped space, or under whose direction? Those types of things. Did you do all this? Did you do substantially all the activities, or did you have anybody else? All right. The reason this stuff is all important, and it will come back into play, I'm going to make it just a little bit smaller, is because we have all sorts of funky tax rules based off of this little setting. So we are an Airbnb, and I just want to get something really clear right out. Airbnb is kind of like, the way it's positioned itself is it's almost as easy to book as a hotel. And this is really important because a lot of Airbnb people pretend like that's not what they're doing. They're like, oh no, I'm like more of a rental. No, it's not. I do both. I know exactly what it is. And it's markedly different. Like than if you're just doing a long-term lease, like I'm doing a year lease or a half-year lease. Makes a huge difference. This is not even like, it's not even close. Really what you're doing is you're saying, hey, there's enough in here that we can treat this almost like you're coming in and using a hotel room. And that gets more and more important. And the reason being is, real quick, I'm just going to skeet through this, because it's 7 days or less, then we have to look at certain laws. And so I'm going to go to some regs, and regs are, this is the regs that set it out. It's called 1.469, which is the passive activity loss rules. So there's 26 USC 469, and then there's regulations that interpret it and give us clarity on it. There was temporary set out that we still use. And what this says, that section there, they just wrote out, it's 1.469-1T E3 little II A, capital A. And what it says is that typically rentals are considered passive. So the general rule is rentals are passive. And then it says exceptions. And one such exception is 1-469-1T E3 little i's, two i's, A. And that exception is average use 7 days or less. Why is that important? Because if it's average days of 7 days or less, it's not rental income. It's just regular income. It's trader business income, right? Now, there are other exceptions. For example, 30 days, which would be B, right, is 30 days or less, plus, and they use significant personal services. Or you could have C, any period of time, plus extraordinary. Do they ever define significant? No. Do they define extraordinary? Kind of. They say extraordinary is like if you're in a dormitory, right? It's like you pay for tuition and you get a dorm room, or you're in a nursing home and you get a room. Like you're really paying for services. It's no longer rental, it's a service. So if I go to a nursing home, I'm not paying to have a room there. I'm paying to have assistance 24/7. Or if I go to, let's say that I'm going to do a rehab facility, etc. So the reason this is important, so we're just going to knock this out, because most Airbnbs, the average Airbnb is 3 days. So I'm going to assume that Airbnb and VRBO is going to be the 7 days or less. Let me just, I'll actually do this a little differently so you guys can see it better. So average Airbnb is 7 days or less. So that's number one, is 7 days or less. So we know it's not rental. So number two is, what is it? It's business income. So it's trade or business. Boom. And we have different types. The reason all this stuff is important is because of something called self-employment tax. You don't know what self-employment tax it lives in a code provision called 1402. So 26 USC 1402. And what it is it's OADSI, old age, death, or disability survivors insurance, which is 12.4%, and hospital insurance or Medicare for 2.9%. So total up, this self-employment tax is 15.3%, right? It's going to get triggered if you are materially participating and if there are enough services that are associated with this, that it's going to be considered an active trade or business instead of just something that, you could still be a passive business, but it's going to dictate where these things go on your tax return. So these little guys here come down, and you have to look at services rendered for occupants. And this is going to be C2. So I'm going to look at 1402 C2, and it's going to say services rendered to occupants. So rentals, this is really, I'll make this easier. C is rental from living quarters, which is what you're doing in Airbnb. They're going to live there, right? They're going to stay there. So then we look and you say, number one, there's no services, equal no self-employment tax. Number two, services, and all it says is services rendered for occupants. So this is what it says, and I'm going to read it for you. So I'm going to pull this up so I can just read it. Payments for the use or occupancy of rooms or other space where services are also rendered to the occupant, such as for the use of occupancy of rooms or other quarters in hotels, boarding houses, or apartment houses furnishing hotel services, or tourist camps or tourist homes, or payments for the occupancy of space in parking lots, warehouses, storages, garages, do not constitute rentals from real estate. Consequently, such payments are included in determining net earnings from self-employment. This is really important. It doesn't say what level of services. It says services for occupants included, and I'm going to actually just write exactly what it says. Such payments, ... such payments are included in determining net income for SE from self-employment. So it actually says from self-employment, since I'm quoting it. All right. So you have a lot of people out there, really smart people, that like to say, oh, no, it has to be services rendered during the occupancy. So like one of the things that they immediately say in a lot of the publications is like made services. So here, generally services are considered rendered to the occupant if they're primarily for his convenience and are other than those usually or customarily rendered in connection with rental of rooms or other space for occupancy only. The supplying of maid services, for example, constitutes such service, whereas the furnishing of light and heat, cleaning of public entrances, exit stairways and lobbies, and collection of trash and so forth are not considered services to the occupant. So remember, we went over here and we said what services were provided. So let's highlight this right now. We did all of these things, right? Those are services rendered. The more you do, the more unlikely it is that you would ever be able to get out of paying the self-employment tax. If you're just doing a room, like just think about this. I'm just providing somebody an apartment or a house. Hey, here's a house. You're going to rent it for 12 months. Great. Stop by the manager's office. We'll give you the keys. We'll sign up a lease. You know, hey, if the toilet clogs, you can call me. I'm not doing anything else. Guess what's not included? Furniture, linens, plates, coffee, stuff in the refrigerator. All that stuff is not included in a typical situation, right? We could sit here, we could argue about this all day long. I just know that the IRS looks at this and their audit guide basically says right off the gate, that's what this is. It's a trader business. So they're going to walk in here saying, this is a trader business. You're going to be subject to self-employment tax. And you can sit there and try to argue your way out of it. I tend to not want to deal with that. I'll show you a way to avoid it all entirely. But if this is just you operating and you're somebody who says, maybe you talk to a really good accountant and they said, hey, put this in an LLC. So they put the little house in an LLC and the owner is you. So it's going on your schedule E or C. They're going to put it on your schedule E, but if it's trader business, guess where it goes? It goes on schedule C. Unless you provide no services. If it's no services, then it's schedule E. It's supplemental income. It is not rental income. Get that out of your head. If it's 7 days or less, it is not rental income. It's no different than you getting a check for any number of services. And then the only question is it subject to self-employment tax? And more importantly, did you materially participate? And that's this step 3 over here, is who managed the property. There's 7 tests for material participation. The most common tests that we look at, and I'm just going to keep sliding this over and then I'll wrap it all up in a bow for you. I'm just going to say material participation. Why is material participation important? Let me break it down for you real simple. If you do not materially participate, losses are passive if no material participation. So it's no different than I'm a silent owner in a pizza shop and I'm not participating in it. It's passive income or loss. So losses are passive. This is the big one because passive losses can only offset passive income. So if you have a W-2 job and you have losses from your Airbnb and you're like, oh yeah, this is obvious. This is going to offset it. No, it's not, because those losses are passive. So they're trader business passive loss. So losses are passive if no material participation. Ordinary loss if material participation. So, here's me, yay. And here's somebody else. I'm going to say, here's somebody else. Here's, Johnny. Johnny goes, hey. Let's say that me and Johnny. So I have an Airbnb. Let's say that I have a W-2 job and I'm making $100,000 a year. I have a Airbnb that I bought for $500,000. It has land value of 100. So I have $400,000 of improvement value. So in my first year, let's just say I get $120,000 depreciation. This is called bonus depreciation from doing a cost segregation. You can look at other videos if you don't know what that is. We're accelerating the depreciation. And don't worry, there's plenty of videos on it. Cost segregation, any of our real estate tax courses, we cover it. So what I'm really looking at is, let's say that my Airbnb brings in $50,000 after all expenses, but I get to take $120,000 and I get the regular annual stuff too, but I'm just going to make this really simple. I'm just going to pretend like there's no other stuff. Maybe it's right at the end of the year, right? No, I couldn't do that. I wouldn't have 50,000. But let's just say that I made 50. I'm not worried about total depreciation plus regular depreciation is 120. We'll just say that. So I'm going to end up with a $70,000 loss. If I can, I'm going to get a $70,000 loss. That's going to offset my income. So I'm going to end up with $30,000 of taxable income. I just saved lots of money. Yay. If, and this is a big if I materially participated. So I had to have done one of three things. I either managed it, or I spent at least 100 hours on it during the year, and it was more than anybody else, or I spent at least 500 hours managing it. And then even somebody could spend more time with me. And on a single Airbnb, I can already tell you, you're going to get it on participation if you manage it. So you manage, you substantially, or you manage substantially all the time. So substantially all the time is management. So management time, you do all, substantially all. You do 100 hours. Oops. And this could be you and a spouse, by the way. You add up your time, and it's more than anyone else. Or you do 500 hours. Those are the three we're really worried about. There's 7 total tests, but the other 4 seldom come up in this scenario. So you're going to get material participation, which makes your losses active. Johnny, on the other hand, he buys, same situation. Johnny has W-2 of $100,000. He gets an Airbnb in the state next to him that has a coast. Like, let's say me, I'm in Nevada. So Johnny goes to California and he gets an Airbnb for $500,000. He has land value of 100, same scenario. So he has a basis of $400,000 for depreciation. He gets $120,000 of bonus depreciation and depreciation in year 1. I'll just call it year 1. And he has the same thing. He makes $50,000. So now the question is, all right, we have to worry a little bit now about this because we have passive loss. He had somebody else manage it, clearly, because it was out of the state. And I'll just tell you, the IRS's position is that if it's a condo or if it's out of state, you have a manager for it, that they're the material, like they're participating more than you. You actually have to track their hours. There's court cases on this where people lose because they said, I did more hours, and the IRS didn't, or the court didn't buy it. They said, there's no way, you're not there. So there was a gentleman who actually went to court exactly on this issue, and he would go there, and he would document that they were there about once a month, and they were constantly working on the units, and they couldn't say what the manager did. So they just said, hey, we did more than 100 hours. And they said, well, we doubt that you did the most. We find it not compelling, not credible. So in Johnny's case, this is going to be a passive loss. So he has a passive loss of $120,000. He has active, in theory, Airbnb, but he didn't materially participate. So this becomes passive income. And it's still Schedule C, it's still sole proprietor, but it's passive. That's not so bad. So he's going to end up with a $70,000 passive loss. So $20,000 question: can passive losses offset active income? There's 2 times when it could. If you're a real estate professional, or if you are an active participant in real estate, but that's only for rental income. This is just passive business income. And so the answer is no, you can't take any of it. It's not rental income. It's just passive business income. So he's not going to get to take any of it. So his income for that year is $100,000. This guy over here, you carry forward. That's why material participation matters. He pays on 100,000, I pay on 30. And the only difference was because I materially participated and he didn't. Make sense? Even if, like, we don't even have to get into the self-employment tax thing because we didn't have income. It's only on net income. Here we had losses. We had big fat losses. And the only question is, can I write them off? So if you participate, like, hey, I materially participate, then yeah, I get to use it. If I don't materially participate, then it's a passive income, passive loss. And that's what ultimately happened here. So we always have to kind of look at those things and we get to determine. Now, we didn't even have to get into the test over here of check in, check out, are all those substantial services for purposes of the self-employment tax, because we didn't have any income. So I get into these arguments with people. I shouldn't say arguments, but we have people that get real, they're really focused on these because they're like, hey, I don't ever want to pay self-employment tax, and they'll have losses. And I'm like, well, I mean, you're going to have it at some point. I'm sorry. And well, they look for someone to tell them what they want to hear, which is fine. They go wherever you're comfortable. And I'm just going to say, well, I mean, I know how the IRS is going to treat it. You're going to end up in a tax court case. And so you're kind of looking at those three things. So let me reiterate, and I'll wrap this all up. So there was three things that we hit. We hit number one, average days. Number two, self-employment tax. And number three, material participation. So this only comes up if you're 7 days or less, 7 days or less, 30 days or less, plus significant services, more than 30 days, plus extraordinary services, 7 days or less, or actually I should say, it's not really the self-employment tax, that's whether it's even rental. So I'm going to just change this. The average days goes right here. This is whether it's rental. Is it rental? I'm just going to put non-rental is these are the exceptions to the rental. So it's no longer rental. And then do I have a self-employment tax? The question is, are there substantial services provided? If it's 7 days or less, for 30 days or less, you get into the other. So it's kind of a hybrid. So we still have to ask. Material participation then comes into whether is the loss active or passive. Boom. Makes it really, really simple. So we have a property and we're doing Airbnb and you're averaging 3 days. The first question that I'm going to ask, I'm going to ignore the issue of personal usage. So like if you're using this thing, let's say it's rented for like 14 days or less, you don't have to recognize any of the income. So we're going to assume that we're not dealing with the personal activity, but whether it's a vacation home and whether any of those rules apply. I'm just going to assume that it's a true Airbnb and you're not using it, but maybe once in a while. Really, we look at 10% or more than 14 days, but if it's 14 days or less, you don't have to report the income. But let's just say that you're averaging 3 days. It's more than 14 days, right? Then we get into this thing and say, all right, 7 days or less. So this is not rental income. Are there substantial services for the convenience of the user, of the occupant? If it's yes, then it goes on your Schedule C. So it goes on 1040 Schedule C. If the answer is no, so are there substantial services? No, then it's going to go on 1040 Schedule E. And then, did you materially participate? And that determines whether or not the loss. So whether the loss is going to be active whether the income is going to be active, whether the loss is going to be active. So I provided substantial services and I did not materially participate. So if it's yes, then you have self-employment tax plus its ordinary loss. If it is no, then it is passive loss. And we don't worry about it because when it's a loss, we don't really care about the self-employment tax. So last area is down here. You could still have on Schedule E, same thing. Is it yes? Did you materially participate or no? We're really looking for the loss again as to whether the loss is going to be an ordinary loss. If yes, then you have ordinary loss. If you have no, then it remains passive again. And that's how it works. So if you're Airbnb, this is exactly how it's treated. Again, there's lots and lots of bad information. They still call it rents and things like that. Technically, 7 days or less, it is not going to be considered rental income. Here, I'll take this thing off so you can actually see me again. I think it's going to do that. There I am. All right. So if you are renting something for 7 days or less, it is not rental income. So you're renting a house 7 days or less, average occupancy. No, it is not rental income. It is now just ordinary income. Then the only question becomes, if you make income, is it subject? So if you have net income, net profit, is it subject to self-employment tax? If there are services being provided, substantial services, then the answer is going to be yes. If there are no substantial services, so it's just basically raw shell, and that's all I'm giving. I'm giving you you're coming and picking up the keys, and that's about it. I mean, there's actually a court case where they litigated providing laundry machines in a mobile home park, whether that was substantial services. So everybody's like, oh no, it has to be during the tenancy. No, that is not what it says. It is any services for the benefit of these folks. And the question is it substantial or not? We don't really get much of a definition. So all those things get added up. But if there are no substantial services, then fantastic. Then we're not on Schedule C, we're on Schedule E. And hopefully it's going to be a non-passive loss. It's going to be ordinary because you materially participated. Otherwise, it's going on to C, but it's still passive, in which case it's just going to be treated as any other passive income. Like literally, they're treated almost identical no matter what. The only question is, if I'm making money, am I going to have to pay self-employment tax on it? That's really what it comes down to. If it's losses, all I care about as a tax person is, did you materially participate? Because it's really not going to make much of a difference. And yes, there are some huge benefits that you can get. So I hope that helps clarify it. If you can follow along with this and you can follow these rules or just work with somebody that does, then this stuff can be really, really powerful for you. If you have high W-2 income, then it might be a situation where you buy an Airbnb, use the bonus depreciation in year one, self-manage it, do everything you can to make sure that it is active loss. And then in year two, switch it over to a manager. You're allowed to do that. Or the last thing you can do is the real simple way, if you just want to avoid the issue entirely, is and I told you guys I would give you this, the way to do it, is you just put the property into an LLC, you lease it to a corporation. In the corporation, I lease it on an annual basis. So it looks like this. I'll just give you guys the screen. I don't need to be in the corner. But I have the house in an LLC and I lease it long, meaning, let's just say it's 6 months to a year, and I lease it to a LLC or corp, and it's going to be taxed as an S corp or C corp, and this is the host. You're leasing it to a host. So we have real estate that is passive real estate again, and we're leasing it to a host, and the host is then dealing with the occupant. So I might be leasing it for, let's just say I'm leasing it for $3,000 a month, and the host is generating $5,000 a month. That means 3,000 is going back over here. This is going to be on my Schedule E. Yay. And then the corporation is either going to expense all that away, get it back out to you. There's tons of different ways, or it's just going to sit on it, depending on what type of corporation it is. But now you don't have to worry about paying the self-employment tax on it. So that's the workaround. So I told you guys I would give you that before I was done. All right. Hey, if you like these types of videos, by all means, subscribe. If you think that somebody could benefit from this, by all means, share it. But at the end of the day, what I care about is people having accurate information so that they can make intelligent decisions. All too often, there are folks out there that put things out on the internet, and I get it. Like, everybody is trying to do the best job they can. Just make sure that whoever is signing your return is comfortable with whatever position you are. Somebody can be very aggressive for you. I tend to look at it and say, hey, just make sure you're not doing yourself harm. Like, I don't want to take a position that I could still get to in another way if the lazy position is going to cause you an audit. There's just not enough money to deal with audits, because you never know whether it's going to be audit that starts off really small and then they start looking at everything, and the next thing you know, you're in a 2-year audit and you've spent, you know, $70,000-$80,000 having to defend against. Sometimes it's a well-intentioned but misinformed agent, or you're dealing with that agent that's had a really bad year. You just don't want to be dealing with that. So I like to avoid audits. Our guys don't, you know, our clients, we do about 10,000 returns a year. We have less than 10 audits last year. It was nothing. I like that. And so I'm teaching you the way to avoid the audit rather than the CPA out there who loves to defend you in the audit, right? So I want to make sure that you are doing things that keeps you out of harm's way. And there's so much weird information out there. Hopefully we can add some clarity to it and help you out.